please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good afternoon and thank you for joining us. This is Halftime Report. It's 12 noon and we are here to take you through what's happening on the street so far and what the cues are looking like for the rest of the session. I'm Surabhi Upadhyay and with me is Nigel D'Souza. Nigel, I was just looking at the Nifty, trying to figure out some trends, something. It's extremely hard to come by. Banks are split down the middle. Some tech excitement is still continuing. Some heavyweights like Reliance are sulking. Indices as flat as you can get.
Well, Surabhi, it's in cricketing parlance, it would be like we started off day one of the test match. In fact, we're getting into lunch and you're not moved at all. The batsmen are just playing it out there. The Nifty is virtually unmoved, and guess what? The non-striker, that's the Nifty bank, that as well is unmoved.
Yeah.
Just take a look at that. That has recovered close to around 50 points from the low point of the day. But both those two indices as flat as can be as we speak. But if you're looking at making a lot of money, and in fact, you're looking at individual stocks, there are plenty of opportunities out there. Just take a look at the mid-cap index. In an otherwise flattish market, you have the mid-cap index that's sitting with a gain of close to around 0.8%. So maybe, in fact, the frontline index may be a little bit deceiving. If you look at the broader markets, there's plenty of money being made out there.
Okay, so let's get started with our movers and shakers. As always, like we told you in the headlines, it's all about individual stocks today because there's plenty of action beneath the surface. So to start off with, let's take a look at Orient Paper, where interesting corporate action is going on. There is a split. The reason why that stock is looking down 70% is because one part of the business, which is the consumer durables business, that's going to be listed separately. It will trade differently. Nigel, help us now understand what the valuations are like, because I guess consumer durables is where the action is supposed to be. That's supposed to be better valued, right? At least on a per share basis. Absolutely,
Surabhi. Yeah. And one more thing, people were playing for this demerger. They were saying it could come at some point of time. And everyone talks about having khabar. At times that khabar is not really required. Why? They announced this demerger in September 2016. At that point of time, the market capitalization was around 1,600 crores approximately, right? And if you take a look at it yesterday, before this, before only the paper business listing, the market capitalization was roughly around 3,600 crores. So after them announcing this, you have those approvals and all, and the stock has doubled your money. They announced it at around 75 to around 80 rupees, and yesterday the stock was trading at around 175 to around 80 rupees. Let's pull that market capitalization chart up for you on the screen. Oh, I think we're going to be pulling it up in a bit. Any which ways, Phillip Capital, they came out with the note. They have a buy rating, and they have in fact a target of around 200 rupees per share. Why? They're valuing the paper business at around 7 times EV upon EBITDA. So they're giving it a value of around 50 rupees per share. And the electric business, they're giving it a value of around 30 times. Remember, some of its peers are trading at around 35, 38, 40 times as well. So at 30 times, it's coming to around 150 rupees. They said that earlier it was trading at only around 20 to around 23 rupees. And they're saying that, in fact, operational strength will be seen in the coming days. It's a good brand out there. So that's why 200 rupees. Today, in fact, it's only the paper business. That's why it's appearing the stock is down. But that they're valuing only the paper business, which is roughly around, 25% of their total revenues.
Okay, I just remember that Orient PSPO ad. I think that was an epic piece of advertising. That's the business that's going to list separately in some time. Let's focus on the next stock then, and this one is Bajaj Corp. It's in focus because of a note that Macquarie's come out with. They've initiated coverage and they have a smart price target. 515 on the stock today. They are calling for 637. What's making them so optimistic? Let's ask Manglam Malum. Manglam.
Well, you guys are talking about Orient fans and all of that. So one of these legacy products is also the Bajaj Almond Drop Hair Oil. So that is one of the companies in focus today. Incidentally, comes out with results, and on the day of the results, Macquarie has initiated coverage on the stock. If you take a look at the stock, last a few months, in fact a couple of years, it did nothing. Just from October it rose about 20%. People talking about valuations. 90% of their revenues comes from the Almond Drop Hair Oil, which was battered by competition. So let's see whether it is now turning around. In terms of the results, we're expecting a 15% revenue growth. EBITDA is likely to contract by about 280 basis points. The margins, that is primarily because the company is advertising a little more and increasing their distribution. Net profit as a result of that likely to grow by 3.3%. Last quarter there was a bit of a turnaround on the volume front. The company posted a volume growth of 6.5%. This after all the GST, competitive demonetization uncertainty coming by in the previous few quarters, and this quarter we're expecting a 10% volume growth. Macquarie believes that this is a value buy right now at these levels. trades at a 40% discount to the FMCG peers. But the big question is, can it really turn around? Because the last a few years, it hasn't shown growth, and which is why the value that it trades at right now.
Okay, all right. Mangalam, thanks so much for that. Well, stock is trading with a gain of around 3.5%, but there are plenty of more stocks that are news, and Ronit, our man, is standing by. He's going to run us through all the stocks. Ronit, over to you.
So, 3 stocks on my radar. First, I'll start with Som Distilleries. Equity intelligence fund, they bought around 5 lakh shares. As well as Purinju, the head of the fund, has bought around 1.5 lakhs in his personal capacity. Remember, he's also bought BSL Enterprises. Remember, they're having a lot of, interest in these distillery as well as these alcohol stocks. Moving on, Dredging Corp. So, reports indicate that the government may sell plans to sell their stake in the company. A lot of marquee investors are in this stock, because the shipping ministry is opposing this stake sale. But we haven't independently verified this report. And finally, one last stock is GE Power. They were awarded a contract of around 818 crores by the orders from Navayuga Engineering. And if you see FY17, their order inflow was 2,200 crores. So this is almost 40% of their FY17 order inflow itself.
Okay, thanks very much, Ronit, for rounding up those stocks for us. Let's now move on to a lot of the commentary that we got around one big piece of news. After the cabinet allowed 100% foreign direct investment under the automatic route for single brand retail, we caught up with Rakesh Bayani, joint MD of Future Retail, as well as J. Suresh, MD and CEO of Arvind Lifestyle, to understand what this could mean for the retail sector.
Significant amount of policy announcements have happened in the previous government and this government. Unfortunately, none of them have really attracted any amount of significant FDI in India. And I think that is more to do with the complexity that exists in the entire policy thought process. Brand-wise policies, category-wise policies, and now different ways of calculating the sourcing norms. I think it's just too complex for a simple trading business called retail. I would say, companies like IKEA or companies like H&M, which are both 100% FDI investments, and both are large investments, they would definitely benefit from this.
I think it just eases the ease of doing business, and also in terms of sourcing norm, I think it will also encourage make in India for some of the global people. So as a fashion retail, I'm not expecting a huge amount of inflow of foreign exchange because of this change. Mainly because even otherwise the approval route was available, and it's a question of 3 to 4 months delay. You can always open a retail store. So I don't see a big impact in terms of the foreign exchange investment, and I think it's more complexity in terms of the retail policy, which has to be untangled if really the country has to attract international investment into retail.
Okay, then let's run you through and do a quick recap of all the buzzing stocks that we just covered. We have Orient Paper, we have Bajaj Corp, Future Retail, Arvind, Dredging Corp, Som Distilleries, as well as GE Power. And the Nifty Bank has recovered all of its losses. In fact, it's moved into the green, and that's what's taking the Nifty as well higher. Remember, in early morning trade, the Nifty Bank was trading with a cut of close to around, 50-60 points approximately. We're seeing a bit of a recovery from there. And it's not just that. Even from the broader market, something like a Good Luck India, we should get the intraday chart up for you on the screen. That stock as well is moving higher. Westlife Development as well. Remember, that stock has been doing well. That stock as well moving higher as we speak. So we're moving into the green. Let's see whether or not we can hold on to that levels. But let's move on then. Almost a decade after the Satyam scam came to light, market regulator SEBI has banned Pricewaterhouse entities from issuing audit certificates of listed companies for a span of around 2 years. Yash Shane joins us to fill us in with more details. Yash.
Well, as you rightly pointed out, after almost a decade-long investigation, market regulator SEBI has finally passed its order, and indeed a very strong one with respect to the role of audit firm PwC when it comes to the 8,000 crore Satyam scam. SEBI in its order has found that PwC's Indian partnership firm, which is Pricewaterhouse, was guilty of concealing the Satyam scam, and in its order it has very clearly stated that none of the entities of PwC in India will be allowed to conduct audits of listed companies in India for a period of 2 years. SEBI has also said that S. Gopalakrishnan and Srinivas Thaluri, two PwC affiliated chartered accountants who worked with Satyam between the period of 2000 to 2008, will also not be allowed to conduct audits of listed companies for a period of 3 years. And that's not all. Market regulator SEBI has also ordered a disgorgement amount of 13 crore as more of a penalty amount which will have to be paid by PwC as well as the two affiliated chartered accountants it's as a punishment for the entire process where it failed to perform the main role for which it was appointed. As far as the order is concerned, it's a strongly worded order where SEBI has very clearly said that PwC did not perform its role when it comes to keeping external checks, when it comes to the bank account statements, when it comes to the TDS receipts, when it comes to the invoices, the fake invoices rather, which were generated by Satyam, which led to overstating of the financials of the company and so on and so forth. And as a result of which, of course, the headline becomes that PwC has been barred from conducting audits of listed companies in India for a period of 3 years, and also a disgorgement amount of 13 crore, which will have to be paid by PwC as well as its 2 affiliated chartered accountants.
All right, Yash, thanks very much for that. Yes, an exhaustive 108-page order. Still going through some of the operative parts. We have with us Mr. T.V. Mohandas Pai, Chairman of Manipal Universal. Of course, Mr. Pai, we all remember that fateful day. I mean, it was quite a huge blow to, the image of corporate India. But of course, a lot of water has flown under the bridge since then. You know, the points that my colleague Yash was also mentioning, I was trying to pick out some of the instances from the order. I mean, for instance, the SEBI order clearly stating that Pricewaterhouse failed to acknowledge that internal audit did not conduct verification of bank balances. Exhaustive verification of cash and bank balances was left to the statutory auditors. And, you know, the internal audit plans did not have the checks and balances in place. So first questions, a 2-year ban coming in on the auditors. Your first thoughts on what SEBI has done and what the final implications are.
No, I commend SEBI for that. SEBI has done a very good decision. I know this case very well. There was dereliction of duty. PwC did not follow auditing standards. The partner was hand in glove with the company. He did not do his duty. It was a failure, and it went on for many years. It is not a fraud that happened in 1 year. It was there in the books for many years, and they did not detect it, and they were hand in glove. It's very clear. I'm very happy SEBI has come down. It sends a message to the auditing profession that they have to take their work seriously. If they do not, SEBI will take very strict action. Remember, SEC banned banned Anderson, and they had to wind up. And I think it's a good thing that they've been banned for 2 years. It brings an end to the Satyam saga. In one way, the regulatory actions are all over. The criminal actions against Raju are still going on. I hope they come to an end. But this is part of cleansing up the financial system, cleansing up the listing system, where auditors, if they do not do their work, they will be punished, they'll be suspended. I think it's fantastic. And in this issue, the Institute of Chartered Accountants has failed thoroughly. I'm a member of the Institute. I'm an FCA, and I say it on record, they failed because as soon as they heard about it, they should have sent a show-cause notice to the partner and suspended him, come what may. Because it was very clear what has happened. Raju had accepted that a crime was committed, a fraud was committed, but they took action slowly. It hurt the reputation of the Institute, all our reputation because of lack of action. And I'm happy that SEBI has taken this action. This is very good news. And I hope that in future, if anything goes wrong, if the qualifications and if wrong certificates are given by the auditors, they're suspended and they're told that never compromise on your standards and ethics.
Well, Mr. Pai, definitely, as you're saying as well, and totally with you on that one, that it's a step in the right direction. But there's one argument that, what about the timeline? Has it come too late?
See, let me tell you, PwC went and paid, I think, $25 million and had a consent order with SEC. They went to SEC, they had a consent order, they paid up. But here in India, they're fighting the case. They knew they were wrong. They had to go to SEC. They had to accept their mistakes, go to SEBI and say, yes, we committed a blunder. We have put process in place. We'll not make it happen again. This is what it is. And we want a consent order. Instead, went on litigating, went on delaying. Well, that is it. I mean, justice has to be done. Justice is slow but sure. Justice has to be done. And SEBI has done justice. SEBI comes out with flying colors. Yes, there has been a delay. The delay is for many reasons. But SEBI comes out with flying colors because it stood for probity, integrity, and standards in the entire financial system, in the entire, stock market system. So I think it's very good news. I know there's time, but, PwC cannot deny the liability. They're better off if they accept it, take a hit on the cheek and run, rather than going through another round of appeals, because the reputation will be spoiled. People make mistakes. In the financial system, people make mistakes. Banks make mistakes. You accept the mistake, get it on the chin, pay the fine, whatever it is, and go on with the life and make sure it doesn't happen again.
So, Mr. Pai, sir, that's my question. A 2-year ban Is that enough of a deterrent? What else would you like to see? Or do you think that sends a very strong message and hopefully we won't see a repeat?
Well, I would have done a 5-year ban because I think it's a very, very serious fraud that's committed and they did not do the job. But I guess SEBI knows what it's doing. SEBI knows what it's doing, and SEBI is mild. But, I want to raise another issue with you because I think it's a very important issue. In the last many years, there's been a consolidation of all audits with the Big Four. The Big Four have grabbed 75-80% of big companies' audits. Now, if one of them crosses the line, and the probability of anyone crossing the line is quite high because many of them are led by fees and not by the quality of work. And I know many things that happen there where they have compromised. I mean, some of the things are very commonly known. And if they do that, if one of them is suspended like that, the risk is too much. I think the government and the institute should come out with some regulations where they restrict the market share because the risk is very high. Remember, when Anderson went down, there was a big five, they became the Big Four. Now, if one of them goes and does a boo-boo and gets shocked by SEC, and SEC comes and says, we're going to suspend you, what happens to thousands of companies they audit? Because there's so much of consolidation. So the risk of consolidation in this is very high. And the Indian firms have been driven out of business because of change of auditors and everything else, and the huge resources they have. So I think we need to have a discussion of systemic risk arising out of consolidation too.
Mr. Pai, hello sir, thanks for joining us. This is Yash here. So one question on the larger issue of consent application. If you look at PwC, it's of course a ratings agency. There's a very serious fiduciary duty which it carries. Do you think the route of consent application should not be allowed for institutions like ratings agencies or exchanges, and there should be some differentiation when it comes to companies and institutions like rating agencies and exchanges when it comes to the consent application?
You see, in the financial markets, people make mistakes. Mistakes happen. It is not intentional. It happens because of processes, oversight, because, we are live in a very competitive financial system, in a big trading system. So having a consent form is very, very important, and consent is the right way to go because we have to move on. We cannot keep on dilly-dallying and taking more time. So consent is a good way to get forward, get hit on the cheek. For example, in the U.S., for mortgage, mis-selling, and for all the things that happened when you sold bad mortgages, they all took the hit, and I think the government collected about $50 billion of fines, and the litigation, it came to an end. You can't have prolonged litigation because both sides will fight, and the outcome may be a nasty one. So consent is required, but wherever there's criminal action, you can't do consent. When there's criminal action means deliberately misleading people. With criminal action, the deep-set conspiracy to defraud, there I think the consent does not apply. I think consent has matured in this country. It's gone through many phases with SEBI. SEBI has a very good track record of handling consent. They put a process in place. They have the right approach. And I think we should leave with the consent because consent system is required for a very dynamic financial system.
All right, sir, take your point on board. Thanks very much for sharing your views with us on the matter. So that's the Satyam saga after 9 long years. Finally, an order coming in from SEBI, and that's in the form of a 2-year ban on Price Waterhouse.